It all comes back to the DNA. The firms that know who they are will know who to be. You can learn a lot about an investment firm by listening to what they say. Alpco's Mainstream's AGM Originals, The DNA, Capturing Culture, is dedicated to capturing the DNA of a firm by listening to what they say. The first season of The DNA stars EQT, a global investment firm started in Stockholm in 1994 that has over 270 billion euros in AUM. I sat down for conversations with 9 EQT executives in Stockholm this past summer at their annual investor meeting. Each executive came from different parts of the firm and different parts of the world. Each had fascinating backgrounds and stories about how they ended up in private markets and working to build EQT. But there was a single through line threaded throughout all the discussions: the consistency and frequency that each executive talked about the firm's mission, vision, culture, and values. Episode 5 of Season 1 of The DNA stars Beske Nielsen, Global Head of Private Wealth and Evergreen Solutions, and Peter Aliprantis, Partner, Head of America's Private Wealth.
Peter A., Peter B., welcome to the show.
Thank you.
Thank you. Good to be here.
Yeah, thank you.
You both have tremendous backgrounds in both private markets and working with the wealth channel. I would love for you to start by sharing your backgrounds and where you came from, and I think that'll inform a lot of how you're thinking about building a wealth business here. So, Peter B., would love to start with you. Background, how your time in the wealth business has evolved.
I started back in the early days from being a left field, I guess, because I'm actually by education I'm a lawyer, an M&A lawyer. So I joined asset management with BlackRock, and as you can imagine, going 20 years back with BlackRock, it's been an enormous ride with BlackRock. So I've been exposed to private wealth, private markets, institutional, everything that you can kind of spell to within asset management the last 20 years. So I took the journey by starting in London with BlackRock. Then I came to the continent, Copenhagen. Then I moved to New York. And after 20 years of basically being the crossfield between private markets, long only, but also institutional, and then also the retail market of private wealth, I've learned a tremendous lot to how to put together a private wealth business. So really, really great to be, after so many years at BlackRock, to be at a private markets player that only thinks about private markets, and actually so focused that is only private equity, infrastructure, and real estate.
I think that's a great transition to Peter A., where you've been in the private wealth business, I think, before it was the wealth business.
Yeah, before it was cool to be in the private wealth business.
And you've been in private markets most of your career. So I think it's a fascinating combination of the two skill sets and expertise. So I'd love for you to share.
Yeah, so I started my career in the private wealth space. And the private wealth space today is very different than it was when I started, especially in private markets. You know, we always talk about the private wealth channel, but it's not a, you don't deal with just the private wealth channel in a monolithic kind of way. There are many different, ways that you interact with the private wealth channel. But the way private markets used to deal with private wealth is they would say, well, we have these institutional products. We're going to sell our institutional funds to the private wealth channel, and we'll give them some capacity, a couple $100 million in capacity, sell whatever you can, and that's it. No support, no sales support, no reporting. And boy, what a transition it's been. And I would also say that if you were a firm like ours or any of our colleagues and competitors, you didn't view the wealth channel as a massive opportunity set to raise capital. It was kind of something you did on the side. But today, if you look at what it's like today, the race is on to win the wealth channel from all of the biggest private wealth firms on the planet. And so it's gone from a few small competitors that were playing in the space to now everybody wanting to participate. And I think for firms like ours, the fact that we're global, when you have the ability to invest globally, is a very big differentiating factor today.
Yeah. You talk about the race being on. That's a race that you ran at BlackRock for a long time. In traditional asset management, that race is now being run very fast in private markets, which we'll get to. But from your perspective at BlackRock, What do you think are some of the biggest learnings from running that race relatively quickly too, right? The ETF market has evolved over the last 25, 30 years, pretty significant rapid way.
Yeah.
How do you think about what lessons could be learned from that you're now applying to building the business at EQT?
I actually think there's a number of similarities, and people don't really think about it because clearly indexing, iShares, ETFs, and then private markets from an investment perspective, clearly very different. But from a distribution perspective and application in portfolios, in terms of the education needed, massive similarities. The first few innings in the ETF space was all about education as well. What is an ETF? How is indexing and so forth? The same with private markets. Now we really started very early on globally educating the individual investor on private equity model, the real estate model, maybe more known, but also infrastructure. And I think in particular infrastructure. So that whole learning curve of the investor base, there is massive similarities.
Peter, from your perspective, you've been at the intersection of private markets and private wealth for a long time. What was it like trying to educate people earlier on that you've now applied to trying to educate the wealth channel today?
Yeah. Earlier days, it actually was a little bit easier because private markets were less prevalent than they were today. So the number of advisors that actually worked with private markets were small. Like it wasn't thousands and thousands, it was in the hundreds or less. So Peter's absolutely right. And you can see the transition of what's happened. And if you look at a lot of our competitors, they've either joined forces with some of the more traditional firms to be able to get size and scale or to get education and content available to advisors. But it was easier back 10, 15 years ago because there were a lot fewer advisors that were working in private markets. So you didn't have to educate as many people. But today, with the democratization of alternatives, that number has become enormous. And a lot of the distribution partners themselves have become overwhelmed because, we all talk about this number. Well, private wealth investors have somewhere between 0 and 5% allocated to private wealth. Yeah. And that's accurate. But the question is, how are you going to get them? And the target is to get them to, somewhere between 10 and 20. So the challenge that we face and all of our colleagues face in the industry is, how do we do that? And with scarce resources, because even the distribution partners are saying, we need your help. We need the GP's help. We can't do it ourselves because, they have 15,000 advisors in the US, 16,000 advisors. So there's a lot of people that you have to cover. So it's very different today than it was 10 or 15 years ago, for sure.
You talk about scarce resources. Where my mind goes with that is that building the wealth business is building a business. You have a platform to build it on top of, but you're building a business.
Yep.
That's what you did as you came into EQT to do that. Walk us through what it was like as you mapped out with that blank sheet of paper what the wealth business would look like. Because as Peter said, wealth channel's not monolithic. Nope. There's a whole set of decisions that need to be made, the trade-offs that you have to make in terms of how you do this. How did you think about building the wealth business?
It's a very interesting question, because think about it, it's only 4 years ago, 4 years and a bit, that I was sitting on my own at EQT at the desk, just figuring out how do we bring that to the individual investor globally. So different distribution models and so forth. So clearly what you need to do is you need to be very focused. Figure out what are the largest distributors that you need to have a relationship with and how do you get to them. Now, with Evergreens, how do you transform the performance engine that we have at EQT to fit Evergreens? Make sure you hire the right people. And I think hiring the right people is crucial, because if you make mistakes, you have setbacks. If you hire the right people and you make the right decisions, you can move fast.
Talk about hiring the right people. You hired someone to your right, a fellow Peter. And when you thought about building out the business in the U.S., especially as a European heritage firm, how did you think about, and what made in your mind Peter and the way that you think about the wealth business the right way to think about working with the U.S. market?
Well, first of all, you built the business for clients. Our clients is the distributors in the U.S., clearly the end clients as well, but you need to get to the very large private banks and wirehouses. So the first thing you do, or I did, was to go out and consult with the largest distributors in the US, say, what do you need from us for us to be successful on your platform? And they clearly gave us the advice, well, first of all, if you're going to serve the wirehouses, you need a field team. If you want to and serve the private banks, it's slightly easier because they need less, but they need the product and they need it wrapped in a certain way. So it's basically listening to your clients, in this instance, the private banks and the wirehouses in the US, and then assemble all the things to get going.
And Peter A., you came from some very high quality firms before, but US firms.
Yes.
You've joined a European heritage firm in EQT. You had to underwrite the business, the funds, the performance, the strategy as you thought about, one, deciding to join, and also how you'd work with the US wealth market. How did you go about underwriting that?
Yeah, it's a great question. When and Peter will tell you, when I was going through the process, one of the things I said was, I don't want to have to come here and convince you that it's a good idea to get into the wealth business. And, if you're just going to sell your institutional funds to the private wealth markets, that's not something I'm interested in, because the world, as Peter mentioned earlier, is moving to evergreens. And you really need to create bespoke products for private wealth in order to be successful. And if you look at any of the firms over the past 5 to 10 years that have done a good job in private wealth, they haven't just sold their institutional funds. They've built bespoke products for the private wealth markets. And the other thing I would mention that is very important, that I don't think many other firms can say, is that each of those evergreen structures was funded with a significant amount of balance sheet capital from the firm. So when you looked at the firm's commitment to the private wealth business globally, not just in the US, it was significant. And then also, some of the things I said, and Peter just mentioned this, was you have to build a sales force. If you're going to take advantage of the velocity of the capital, especially in the wirehouses in the US, you can't, a lot of people will say, well, the wirehouses have their own sales folks, so we'll just utilize them and we'll hire 1 or 2 people and they'll do the rest of the work. That's not how this works. And, when you divide out that market, it's really, and when you look at the larger firms, you've got a wirehouse sales group, you've got an RIA sales group, you've got an IBD group, and then you've got a family office channel. So there are multiple channels within the U.S., to Peter's point, that you have to think about building out to be successful.
I think the point of channelizing how you approach the wealth channel is really important because it's, as you said, it's not monolithic, it's different. Part of that comes down to something else you said, which is commitment at the firm level to this. There's a capital commitment because you have to hire the right people, but there's also a cultural commitment. How did you think about that cultural commitment, Peter B., when it comes to getting the firm aligned? Because everyone at the firm had to be aligned and bought into actually doing this.
It's very interesting. Like Peter said, when he was interviewing, I was also interviewing at some point with the CEO, Chris Sinding at that point, and he was very clear to me. He said, we, EQT, have made a commitment. We want to win in this space. To me, of course, that's music to my ears because I knew it was going to cost money. And also, Chris knew very quickly that there will be a J-curve to the investment, right? We needed to make some commitments up front before we could start, harvesting for the commitments. So, and also the board, he told me the board has bought into it. So if you think about it, interviewing for my role, building a global business, knowing that the firm has committed from the board to the executive committee with the CEO, that we want to do this, go ahead and build it, right? That was, to me, what made me not doubt in any way that EQT wanted to do this.
I want to unpack what winning means to you. So I think you think differently about the wealth channel. Maybe we could say think with a Q. But Peter A., how do you think that EQT has thought differently about what it means to win in the wealth channel when it comes to what you've done and also how you've done things?
Yeah. I think winning to us means going to the places where advisors need us to go. And what I mean by that is there are multiple meanings to that. One is obviously regionally, right? We have this what you'll hear a lot at EQT is locals with locals. right? And we talk a lot about that from an investment perspective, where we have our investment teams, where they're physically located and doing deals around the world. But I think it's also related to what we're doing in private wealth too, because when Peter built the business, he has a separate team that covers the Americas, a separate team that covers EMEA, and a separate team that covers Asia, because each of those geographies need different resources and different coverage models to go to advisors and provide those advisors with education, with content, with product support, operational support, and all of the things that go with that. And so we have built a content platform called Think, with the Q, right? THINQ. And that is really our platform for education and content. And it really spans it spans the spectrum of people who are early stage in adopting private markets. So what is private equity? How does it fit into your portfolio? All the way up to more advanced things around global allocations, around infrastructure, investing in Asia and investing in EMEA versus just in the US. So I think it really is very special.
Talk about special. I think another element of this is it's one thing for a firm to have values and a strong culture, which I think EQT has, and you hear that in a number of different contexts. Certainly, I think with some of the sayings that you have, that you say, and it's cascades across the firm. Everything from more than capital to active ownership to locals with locals. How do you think about taking those values that EQT has and transmitting that to the new business that you've built, the wealth business?
So I think, first of all, we're still in a people business. So you've got to hire the right people that understand and buy into our values, because by the end of the day, it is the team that we have on the ground, be that in the Americas with Peter or in Asia or here in EMEA, that takes the business to the client. So I think hiring the right people with the right mindset that have bought into the EQT culture is the starting point, 100%.
The other piece of it too, I think you mentioned probably the most important ingredient, which is the people.
Yeah.
But then to, I think, do a wealth business well and have the right type of products for the wealth channel. And again, that could be different products for different client types within the wealth channel, different regions. But to do that, you have to have the right platform on the investment side and the right origination engine, and then the right cultural mindset at everything from the investment level all the way to the wealth side. Peter, how did you think about the ingredients that are required to do the productization of wealth products well?
Well, I think Peter really did a great job when he talked about hiring. You know, when you think about the components that go into building a wealth business, it's not just sales. Sales is kind of the final output, right? That's how you kind of gauge success when we look at how much money we raise. But at the end of the day, as both of us are well aware, you have to create products that match your clients' needs. You can't just sell what you want to sell, right? You have to sell what your clients are looking for. And so Peter assembled a terrific product development team globally that kind of works with, our teams to work and say, okay, here's what here's what we do that's really good, whether it's private capital or infrastructure or real estate. What is the market looking for? And how can we bring EQT to the market in a wrapper and in a way that meets what they want? Not just what we want to sell, but what they're looking for that answers that question.
Yeah. I think one thing, a way to put it, I'm sure you met Connie Jonsson, our founder, right, and chairman. He would phrase it in a way, you have to play not where the puck is, but where the puck is going. That's basically how you can put it together, right? Also with product. You got to think about where is the market going, because another phrase I would use is no one has ever been or become a market leader by benchmarking. Benchmarking you do to check out who's on first base and so forth, but you got to win, you got to move and set your own strategy. You got to go where the puck is going.
Well, on that point, in some senses you've had an advantage, not necessarily being first in the wealth business and first in creating products for the wealth channel. I think it's given you a chance to create the products that you feel fit for EQT's investment engine and platform, and then also, as you say, Peter, delivered to the client. How do you think about building a wealth business, having had the benefit of watching some others build it, and then say, how do we want to actually tailor this a locals with locals mindset
Yep.
to the EQT local mindset.
Yeah, I think there's two answers to that. One is you can, of course, also in our industry be enticed to do some M&A, i.e. go out and buy some of those capabilities. I think what is very important and we have seen in our industry is that we're moving so fast that the number of things that was developed in the private wealth segment or industry in the first inning is already becoming obsolete. So not buying what is already there, I think is an important decision in itself. So that's the first piece. The second piece is then, so where is the puck going? Having very tight discussions with your distribution partners, basically co-creation product or co-creating product, I think is crucial to what we do. Because if you try to sit in a vacuum and think about what do we have, what can we produce, it's not going to take you to a success in the market. You're going to go, what do we have? How does that marry up and tally up with what is the distribution partners? What do they really want? What do they see? What do the advisors want in the portfolios? So I think that co-creation with our partners is super crucial to winning in the future.
So let's put ourselves in the shoes of a distribution partner. Their frame of mind, when you're talking to them, what are you saying is differentiated about EQT's platform?
Well, there are a number of things. I think what's come across most recently is the global nature of our business. The fact that we're not just a U.S.-based firm that flies people out to London or to Hong Kong or Singapore, does the deal, and then kind of the deal team gets on the plane and kind of flies back home, right? When we talk about locals with locals, which is what we mentioned before, it's really about having deal teams in the region, whether it's the Americas, EMEA, or APAC. And so, I think the idea that in order to invest in, whether it's Europe, every jurisdiction has different legal jurisdictions, different legal codes, how you do business there, knowing the local businesses, knowing how to do business in those particular regions. Even within a country, maybe region to region, there are differences. So that's very important to us. And I think one of the things that is a misnomer with a lot of advisors today is, they look at, let's say, Europe, and they say, well, Europe for a long time has underperformed the U.S. markets. And that's true in the public markets. But when you look at the private markets, that in fact is not the case. And the opportunity set in the private markets is much more significant. In Europe, 95% of the companies in Europe are private. In Asia, it's 85%. And in the U.S., it's 90%. So without looking at those private markets, you're really missing out on a significant opportunity to take advantage of a global allocation.
Peter B., you've been in Europe for quite some time, obviously dealing with clients globally. Why do you think it's so important to be a global firm in today's world of private markets?
If you think about the most important distributors out there, they're global. If you don't come with a global mindset and a global product set, you cannot serve the global distributors. You're simply not relevant. I quite stress the word relevant, because if you want to be relevant to your partner, you got to serve them everywhere. So you got to have people on the ground in the Americas, in EMEA, and in Asia to serve them. And to Peter's point, you got to have the right vehicles as well. There are certain jurisdictions where you need something specific, and those global distributors, they want and expect that from you. If you don't deliver, you cannot be a relevant global partner. It's simple as that.
What do you think distributors and clients really want when it comes to working with private markets firms, and what fits well in their portfolio?
Well, first of all, our license to operate is performance. That's kind of the table stake. And then they want also convenience, but also making sure they got their various statements, to the right time, delivered in the right way. We need to adopt that mindset in our industry to make things convenient for the end investor.
Peter A., what do you think the U.S. wealth market wants?
Well, I think if the recent year or 2 years is any indication, and we talked about this a little bit earlier, Evergreen is the future. And if you look at it, when we talk to our distribution partners, what they're telling us is, for the first time, the amount of capital that they're raising in evergreens has surpassed the amount of capital that they're raising in drawdown structure products. But on the evergreens, because that capital is now flowing to evergreens, because to Peter's point, it's ease of use. that's where they'd rather be. They'd rather have some type of liquidity window. It's easier to allocate. There's no J curve. They're compounding their returns every day as opposed to only getting returns on their invested money, not their committed capital.
Evergreens itself has a nuance to it. Not every evergreen structure is the same. Different firms have to create different types of evergreen structures based on the type of platform they have. Peter A., I want to stick with you on the start of this question, which is, why did you decide to create the evergreen structure that you have for the U.S. market?
One of the things I said to Peter is, what's the structure going to be? And when he told me it was an opco structure, I was very happy, because one of the things that's also really important is, where are you going to raise the money, at least in the U.S., right? The QP business has been very well exploited. There's a lot of options there. There are not as many in the accredited investor space or below. And the OPCO model really is set up to be able to invest with the accredited investor. So it goes below qualified purchaser. The other thing that I would mention that's really, really important is that one of the concerns that we hear from advisors is that if we're going to have multiple private markets players, whether it's in private equity or infrastructure or even real estate, is that we don't want to have overlapping investment strategies across the multiple managers that we work with. Well, we're a control investor. And so that means we basically own the company outright. And so it's highly unlikely that any investment that we own in our OPCO structures is also going to be owned in one of our competitors' firms. So that's definitely a benefit to you if you're an investor in one of our evergreen structures.
That's a great segue. Peter B., why create the OPCO structure, and what about that? It's an innovative structure for the space. What about that jumped out to you as being the right structure to use for an evergreen?
Well, I think Peter touched on it already, is that you want to make sure, go back to convenience, that if you're a distributor and you service both qualified purchasers and accredited investors, if you come with a product that go across both, so you make it convenient for the distributor, the advisor, to look at the client book and say, well, it fits everyone, right? So it's back to that word convenience. It's actually as simple as that.
Another place where my mind goes when you talk about the OPCO structure, it's an operating company.
Yeah.
You think about the heritage and DNA of EQT, comes from the Wallenberg family, which is very much an industrial family. It's an operating company. Yep. Connecting those two things together, how do those things play a part in building your wealth business, that heritage and history of a multi-generational family operating business, as you think about building products and working with the wealth channel?
Well, I think what we're all about is also, both when we invest and when we make investments available for our clients, is the long term. So it fits in 100% well, as I guess as you would expect, right? Because we want to build wealth for the generations. We also want our clients, our distributors, but also the end client, to think long term about our product. We don't want people to trade in and out, because that's really not what private markets is all about. We come in and we own a company for the duration, to build that company and to leave that company in a better space.
You mentioned something really important, which is leave the company in a good place, and underwriting it for the long term. It's something that's threaded throughout, I think, all the conversations that you have. Connie's talked about this a lot, of investing and really thinking about the long term. Well, that's kind of expressed itself in a recent report you put out on IPOs that you've had, and even post IPO and post the point at which EQT owned those businesses, they've tended to perform well in public markets. I think that's a testament to the ways in which that you've helped those businesses through active ownership and operating those companies, creating the right frameworks, foundations in place to enable that to happen. Talk to us about, I think, something that's on everybody's mind, but the importance of how you think about value creation, Peter A., and exits, because that report, I think, is reflective of that.
Yeah, I mean, if you look at the numbers, and we're big on the numbers, right? In the last 24 months, we've returned $30 billion of client capital back to our investors. And as you know, you can't watch CNBC or any of the other Bloomberg. You pick your, channel of choice without hearing about how difficult it is for the private equity community to exit and to monetize and to capitalize on exits. And we talk a lot about diversifying, in the Americas, in Europe, and in Asia. from where we invest, but also, you know, if you talk to Jean Salata, who runs our Asia private equity business, he'll tell you the exit the exit opportunities in Asia are open. If you look at that 30 billion, 18 billion of that is in Asia, and then 12 billion is in the Americas and in EMEA. So it's not just diversification of where we're investing. But so, for example, what I mean by that is, so if the exit market is the IPO market in the Americas is somewhat closed, well, guess what? Well, it's open in Asia. So we might not have as many exits in the Americas, but we'll have some in Asia and in Europe. So you get diversification across markets.
What does the results on exits do for the client conversations you're having? Because I imagine that a lot of investors who are newer to private markets, one of the first things that they think about is liquidity.
Yep.
What have some of those exits, like you mentioned, I think John said that this past 6 months were the best performance in terms of exits for the Asia private equity business in their history.
Yeah.
That's a big deal in a time when it is hard to find exits. What's the tone of client conversations when they're trying to understand how to think about illiquidity and liquidity as it comes to something new that they may not have invested in as much before?
You know, I think performance, as I said, is clearly our license to operate. So it's crucial for our, long-term relationship with both the end client and the distributors that we can show solid exits across the various market cycles. And I think that's what we've managed to do. I think, as Peter said just now, we've actually now, which is not a great IPO market, we continue to see exits, right? And I think that's the fundamentals of having a long-term relationship with your client, is to bring the performance, which hinges on your ability to do exits at a global level. And I think that's what we continue to do, and we are topping all of the charts, as Peter's saying, in terms of exits.
I think those are all things that speak to how EQT is operated. I want to make sure that the Wealth Channel understands the nuances of this space. What would each of you say is your biggest worry, concern about the Wealth Channel starting to adopt private markets?
One is, if memory serves, there's about 14,000 registered PE firms in the US, right? I would say when we talk opco structures and running an Evergreen, there is probably 20 of those 14,000 that have the license to operate with the right platform, operational platform, sourcing capabilities and so forth to do really well for the end client. So my concern is that the rest of the pack is launching products that are really not suitable. So there will be some not great products, and we'll see that in the market, and that's not great for the whole industry. That's my biggest concern.
For me, I would say, the evergreen structures are really gaining significant momentum, as we talked about earlier. My biggest concern, Michael, is that investors need to understand that this is not a liquidity vehicle, that they need to hold it for 3 to 5 years. That's the idea. So the point I'm getting at is the way you sell them is very, very important. And the message that you give to investors is very important, is that, it's not a mutual fund. There are times where you may not be able to get liquidity.
On that point, what do each of you think is still missing from the education of private markets for the Wealth Channel?
I think right now the products are sold by advisors to the end client. And of course, it's the top advisors that have the most knowledge. I think, to Peter's point, to really get out to the mass market, we need to go down the curve in terms of getting all the advisors on board. So I really still think it's education of the broad set of advisors that really haven't adopted yet. So I guess it's adaptation and knowledge about the product, making sure it's sold in the right way, and the nuts and the bolts of these products, the long-term nature, is really well understood.
We're not there yet. We're not there. We'll be model portfolios.
Yeah.
Because if you're an advisor that has not historically allocated to private markets, you're not probably going to pick multiple managers and have an allocation to EQT and to several other private equity managers and several managers in private credit and several managers in private real estate. What you're going to look for, and this goes back to what Peter and I were alluding to, is what is the client asking for? What they're going to ultimately want is a single ticket solution for their clients that they can allocate across their entire book that helps them allocate across private markets.
The other angle that I'd like to cover on the Evergreen side is, yes, I know you both work with the wealth channel, but it's interesting to think about whether or not institutions will start to adopt the use of Evergreen structures. I think there's two interesting points there. One, will they start to adopt it, and if so, why?
Yes, and I would say, just like I say that the private wealth markets are not one-dimensional, neither is the institutional world. And so what I would say, to be more specific to your question, is I think we're seeing that more in the small to medium-sized institutional market. And the reason for that is those folks don't have large investment teams. So what we're seeing is if they can invest in an evergreen structure that's run by the same team, that's run by the same firm, that's run in the same manner effectively as the drawdowns, that's a much easier, to our point earlier, even about private wealth, it's ease of use for the institutional markets as well. So we absolutely see that coming.
Yeah.
And then you think about this from building the wealth business perspective. EQT has over 1,000 LP clients,
Yep.
institutional side. How do you think about harmonizing the work you're doing with your institutional colleagues as you think about how the institutional LPs might think about both drawdown funds as well as evergreens?
It's actually not that difficult, Michael, in the sense that you just need to make sure that you think about it in the right way, that private wealth is a segment, it's a client segment. Evergreen solutions is a product set, right? So if you keep that in mind, we are covering and making our evergreen solutions and private markets in general available for the private wealth segment. But the evergreen solutions, as Peter said as well, is suitable for many more than just the private wealth segment. But even to the largest institutions, I would say, some of the largest institutions have over the last maybe 30 years built a massive book of GP commitments. Some of them have like 150 different managers. That's just too many, right? So you cannot manage that 150 GP relationships, right? You can only go to annual investor meetings every day if that was the case, right? So even the largest institutional investors have to slim down to have a meaningful conversation and relationship with a few or fewer number of GPs, and they could very well allocate to evergreens on the side as well.
In your mind, are evergreens the biggest innovation in private markets in recent time?
It's the beginning of the biggest innovation. We still, because it's still evolving, but the concept of not having to lock yourself up for 10 to 12 years and no J curve, absolutely.
From your perspective, Peter A., what's the next biggest innovation that excites you? Maybe you already answered this with models.
Models.
Okay.
Yeah, I say it's models for
Yeah.
sure.
What are models going to look like in the future? Is it going to be a single firm having one model across all different asset classes? Is it going to be you're going to look to partner with other best of breed managers where you don't have those capabilities or product sets, and you're going to partner to fit the pieces of the puzzle together?
I think Peter mentioned this earlier as well. Some of the larger distribution partners that we work with are talking about putting together model portfolios. So what that would look like, they would take, a number of different private markets players that they work with already individually and put them into some type of model and offer that model out to their advisors. And each distributor will probably have a different model. There may be the equivalent of like a conservative, moderate, aggressive model.
You saw this movie play out at BlackRock. There was an evolution in the business model of traditional asset management. Do you see a similar evolution coming in the business of alternative investment firms coming as well?
I think it's both going to asset management in general, and it's still a long way to go, and to the GPs. Think about any other industry. Any other industry you look at, 4 to 6 players globally probably own 90% of the market. If you think about our industry, there's just so many GPs, right? So consolidation is going to happen, and it's going to happen quite quickly in the next 10 to 15 years.
How big is the window to win in private wealth? And winning can mean different things for different firms. But how big is that window?
I think it's similar to the US, but let's be clear, the private wealth channel, i.e. if you think about private banking where you're selling a product, is only the starting of Evergreen and the adaptation of Evergreens, DC pensions, model portfolios, right? There are so many things or areas where we need to get into with private markets that today is not allocated to private markets. So those channels are up for grabs in the next 3 to 5 years.
I want to end this by asking each of you, talking about kind of seeing through the window, asking each of you a bit of a window into your mind. What in your mind is your most unique perspective on the wealth channel?
So again, I go back to something I say all the time. You know, people talk about the wealth channel as if it's this one-dimensional kind of thing, and that you sell to the channel. If you do this one thing, that there's some silver bullet that if you do this, you'll be successful. I think if that were the case, everybody would do that. But it's not the case. And it's a very, very complex system to operate in. You know, as I said earlier, whether in the US, again, whether it's the wirehouse channel, what you have to do to be successful in the wirehouse channel is very different than what you have to be successful if you're working in the RIA space. Because, you know, in the wirehouse channel, you have a number of wirehouses. In the RIA space, you have 17,000 RIAs in the United States. All of them operate fairly independently, and it's very difficult to capture all of those. And then there's the IBD space and the family office space. So and I'll get back to what you said initially, which was building a wealth platform is figuring out a way to sell and support the structure of each of those underlying client segments across performance, right, which we talked about.
We've touched on it already, convenience. Whoever can participate in this segment and bring convenience to the end client is going to win. And if you just think about the difference of consumption, in a sense, the difference in generations and how they consume other things than investment products, we have to think outside the box as well and think about, okay, how's the next generation, the young people, the 18, the 20-year-olds, and so how are they going to interact with us? Super important. So the ones that can make convenience, because there's a lot of fight for time if you're a millennial, right? So you got to make sure you're convenient and relevant for your audience.
You talk about thinking differently. Well, this was such a great window into how you're thinking about building the wealth business and how you're building it and thinking differently about it. So thank you, Peter A. Peter
Thank
B.
you.
Thank you.
This was great.
Pleasure.
Thank you for listening to this episode of The DNA, Capturing Culture. You can stream all the episodes on your YouTube channel at Alt Goes Mainstream AGM, or read about the episode at my Substack at altgoesmainstream.substack.com. And of course, special thank you to EQT and the executives that shared their stories and perspectives. Thanks a lot, and have a great day.